Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with the man, myth, the legend, somebody doing something for all of us, which we must thank him for. Millennial Mike, how you doing, sir?
I'm good. Thanks for having me on as always.
I still can't believe you volunteered to go through all of my comments to find the ones that we need to go deeper on. I greatly appreciate it. As somebody who does watch all the comments, I don't have time to give detailed answers. So the fact that you will go through, find the good ones, the heaters, the ones that we should go deeper on, means the world to me. So what'd you find this week?
Yeah, so we actually we've got a good list of questions this week. Some of them projections. For all the people out there who are always like, Mike, why do you make projections? It's because people in the comments want to know your opinion. So we'll get to those. We got some projections, some questions about the economy. But I actually thought this was a great way to start. So you always talk about doing the work, developing a buy box. This applies to investors looking to buy their first deal. But the YouTube user Low Sierra, she asked and she says, I came over to your channel and the buy box concept intrigued me. I tried to do one with an Excel spreadsheet, but I'm not sure how a first-time home buyer can use this. So how do you think a first-time home buyer not interested in owning rentals can use the concept of a buy box to get a great deal on a home purchase?
That is a very good question. So I do think the buy box idea plays through. Again, I've only ever bought one home to live in, right? We bought a home in 99 and we've never moved, but we had a buy box. For us, it was we had two school systems that we were willing to live in. And we had a price point, right? We had a can't go above, right? Because we were tapped out, right? We were making 40, 45 grand a year or something in 99. So that was it for us, and we wanted three bedrooms. I'm sorry, there was a third, right? We wanted a bedroom for Olivia and I, one for our daughter, and then an extra one for guests or office or whatnot. So that is a buy box, and so I do think it applies. I think most people probably have a bigger buy box than we did because we were. I mean, let's speak very clear. Our number one thing was a school system. We were renting in the best school system in our area, Cupertino, California, and we would have rented the whole time to be in that school system for our daughter, unless we were able to buy something, which we struggled for a couple of years to make happen. But I think everybody does. I think every homeowner has a buy box. I think, if you look at my spreadsheet, the all the expenses and all of that yield calculation doesn't matter. But I think you have a search criteria. I think you should look at it. I think in a market that's slowing down, you should see trends. I think, again, I would tell every homeowner, I would not look at first day listings unless you're in a super hot market. For me, days on market, I want motivation. I can tell you as an investor or a homeowner, when you could deal with a seller that's motivated, it's better, right? Don't pay list, pay less than list. Get closing cost credit, get rate buy downs. The market is slowing down in most areas. Some Florida still hot, some other areas still hot, but yeah, I think it applies. It's obviously not as much a math equation, but the daily discipline that is built behind the buy box, I think it still plays. At least it did for us.
Yeah, I mean, the reason that you have a buy box is so you can start to figure out and accurately compare and contrast the yield of a property versus the yield of another property. And so you can find the best deal from a yield perspective. Well, if you're not interested in yield and instead you just name your own most important quality, for you it was the school district. So okay, well, what's the best value I can get and still be in this school district? I mean, so yeah, but at the end of the day, doing the daily work, looking at the market every day, those principles are going to help you recognize the good deal, the great value in the neighborhood you want when it comes your way. So,
Well, then
so yeah.
let's not forget the last part of a buy box. It also tells you what to avoid. I can't
Mhm.
tell you how many homeowners like, hey, I want to live in this area, and then they hear somebody say, "Oh, a new development is springing up over there."
Mhm.
Well, that's not over. I mean, yeah. So a buy box is focus and daily discipline, but it also is permission not to get distracted.
Mhm. Mhm. No, agreed. Okay, so let's move on to the topic of wage growth versus inflation. You've touched
Mm.
on this a few times. JT12 asks, he says, you're literally the only person I know who thinks wages are keeping up. And your response was to say, I didn't say that they were keeping up. 6% wages with 8.5% inflation is not keeping up. Can you elaborate for us your opinion on wage growth?
Yeah, I'm glad you caught this one. So again, I'm going to be very clear. In a world of 8.5% CPI and wage inflation of 6%, that is not keeping up. In fact, you just do this math, everybody's falling behind. If you're not getting a 10% raise, you're falling behind. My point about wages is to look out years from now. I believe the wage spiral inflation, I believe it's just started. I believe CPI is going to keep coming down headline. And I do believe wages, maybe next year, maybe the year after, wages will be up 6, CPI will be 4. So you will be getting ahead, but you're not getting ahead today. I believe housing affordability is a problem. It's near record lows. If you follow affordability, there are 3 factors that affect it. Most people on YouTube scream price. And believe me, I want them to be right. I would love a 50% crash. I just don't see it. And I can't be intellectually dishonest just to earn a penny with crash videos. Others can. Others will sell their soul for a penny. I won't. So price is one. Next is rate. I actually think rates are going to go up, at least in the short term, meaning the next year or so, which means affordability gets worse. And then there's number 3, wages. I believe over the next decade, wages will be above trend, right? Trend inflation is 1% real, right? Going up. I think it's going to be above that. I think we are going to bring I want to believe we're going to bring manufacturing home. We have more jobs than people, which means you have to pay them. I think we're going to have a good year. I think unions are picking up, right? Starbucks and Amazon and all these other places, and unions will drive wages higher. So I think wages go up. I think real estate, generally speaking, is flat for 5 years, and wages increase, which will mean affordability slowly gets better. And then if prices are flat, wages go up, and then rates eventually come down, magically affordability looks better. Everybody wants to talk price crash. And dude, believe me, I would be so much bigger of a channel if I could intellectually see that. I just don't and won't sell out for a penny.
Right. Well, one more question on wage growth. This one's from Jeff M. And he kind of touches on some of the topics you mentioned. He says, hey, I thought of something. You said that housing will probably stay flat for around 5 years until wages catch up. Over those 5 years at a rate of 5.5% a year wage growth, or you said maybe 6% wage growth year over year. But he goes, you said that would make housing affordable, but why would wages continue to go up if we're about to hit a recession? Do you think that's going to possibly counteract any of your theory if we start to see layoffs?
So again, that'll be the question. So the question really is, where will the layoffs occur? Right. I believe what we're heading into is a white collar recession, not a blue collar recession. I believe if you go back and you really peel back the numbers, where really the jobs are, they're more blue collar service job oriented. And that's where the wage inflation is actually most meaningful and is accelerating the fastest. So I see a recession that's very much white collar recession, not blue collar. I don't think a recession, at least by the one that I see coming, is big enough to really pull back, right? We're at 3.5% unemployment.
Right.
For most of my adult career, economists were trained that 6% was full employment. Think about that. We could almost double and be at the historical full employment. So I do think a recession is coming. I think recessions are natural. I think one is required. I think this should be deeper and longer than most. But that doesn't mean wages have to go down. In fact, I think wages go up from here. So there's not a one-to-one relationship. I think it'll be a white collar recession. And I think there's wage inflation in blue collar, in trades, and for years to come, I think.
Yeah. And on unemployment, it peaked at 10% during the Great Recession. So we would have to triple where we are at right now to get to where we were back then. Okay, so here's a scenario-based question about how to properly scale. I thought this was a good one, but it's a little bit longer. But one of your subscribers, Denzel Falcon, he says, I'm currently in a duplex, house hacking with my wife. Fantastic, great start. We're currently saving for our next rental. We have opportunities to either house hack a triplex or purchase a single family and slowly build up and buy a new single family every year for around $100,000 a single family home. The triplex is over $350,000, but the rents will pay the mortgage and we can cash flow the unit we're currently living in. So his question is, we are hesitant to take on so much debt so quickly to the point where we can't be flexible. What do you think is the best way to scale? Buy the triplex now for $350,000 or single family houses one at a time for $100,000 a year?
So I think I replied to that comment. Do you have my reply?
I didn't keep the reply was long, so sorry about that.
That's okay. No, I did. Yeah. Every once in a while I go, I got to answer this one better. So I think my net answer was I buy the best yield.
Yep.
Right.
That is what it was. I remember.
Yeah. Because again, the debt level doesn't bother me. It's return on capital. That's what the game is as an investor. If I'm going to put out $30,000, am I getting 10% back? That's $3,000. But if I put out $15,000 and I only get $500 back, that's a 3% return. You might feel better buying the house, but your return is way less. So historically speaking, and I don't know this example or their market or any of those things, I don't think the answer is buying a house or a triplex. I think the answer is go buy a fourplex. Every time I've done the math, a fourplex house hack, you get paid to live there. That's the best return. So again, with those two comparisons, without knowing them or their situation or their market or anything, the debt level doesn't bother me. It's what is the best return on capital? I call it yield, cash on cash. That's all I drive. That's my driving factor. But in closing, I never want an investment to stress you out. So if you are Dave Ramsey-esque and having a $270,000 mortgage will freak you out on a triplex, but you feel better at $80K, well, then it doesn't matter what I say. It doesn't matter. I don't want you to not sleep at night because you got this $270,000, even if it has a better yield. I don't care about the debt level, but if you do, then you do you.
Yeah, I think as someone myself who's a lot closer to the beginning of their real estate investment journey than you are, you have built up the muscle to not be afraid of taking on too much. But when you're just starting out, as I was in my first duplex house hack, it's intimidating to start to stretch yourself. And well, what if something happened? But you get to a point where you recognize that the rents cover the mortgages, you've done the work up front, you've done the due diligence, the property's going to cash flow. It's just hard to take that next step. So like Mike said, if you're too stressed out and too nervous, then don't do it.
Absolutely.
But if you want the mathematical on it, dude, the fourplex is going to be the better investment. Go find a fourplex. All righty, next question. Quick one on retirement accounts from E. Sal. He says, do you recommend investing into a 401k with employer matching 6%? Or should I use that money to purchase a home?
So again, I don't give financial advice. I can only tell you my experience in this situation. I always wanted the company match. My companies did allow me, once you've worked there a year, to borrow 50% or up to 50K. So I did that. I used my 401k probably 6 times to buy properties. I contributed, they matched, I borrowed 50% tax-free. I paid myself back interest. It was magical. I thought it was free money. So that's what I did. Would I have done that if I couldn't take a loan out? Probably. Taking a loan out made it a no-brainer for me. But I probably still would have taken the company match. Yeah, it's 100% gain. But because I could get the gain and borrow, it was a no-brainer. That's what I did.
Right. Yeah. So there's a lot of different things, Roth IRAs, 401ks, some people have deferred comp through a government pension plan like I do. Ultimately, you kind of need to be an expert on your own options out there. It does seem a little foolish to leave 100% gain money on the table. But that being said, with what I've got with my retirement program, I could put a lot of money in, and I know that my money will better be served if I save it, keep it, and put it into real estate. So that's one of the things that I've chosen to do.
Nice.
Okay, predictions. Karthik Heb, where do you think interest rates will be in a 2 to 5 year time frame if Feds keep raising above 3.5 Fed fund rate? So, Mike, crystal ball, what do you think?
Yeah, my crystal ball is broken than everyone else. I do love taking these guesses because frankly, why do I do this all the time? Because I like to beat the experts, right? All these talking heads on TVs. I like to beat them. So I'll kind of give a couple of answers. So I think we end the year close to 6 or 6.1. Which is up from where we are. I think we probably peak somewhere next year in the high 6s. And then I think we naturally end up 3 to 5 years in the 5s. It's kind of where I'm at.
Okay. So I got a follow-up question from me about those ones.
Please.
So if your prediction is we're going to be 6.5, maybe 5.5 to 6.5 as we move forward, for those individuals who are considering sitting on the sideline, not buying, or maybe they took advice to sit on the sideline and not buy real estate, how will the doubling of interest rates from last year to your prediction of what it's going to be over the next 5 years affect their affordability and monthly payment when it comes to overpaying for real estate?
Well, let's just play it out, right? Let's say rates are 5%. I don't know, 3 years from now, and prices aren't crashing, right? Maybe if you're in Boise or some other markets are going to be down. In reality, it's just going to be more expensive. It just is. Unfortunately, people who were calling for a crash last year don't understand math. It was the best year ever to buy, mathematically saying. The year before that was the second best year to buy. These people owe you money for telling you a crash was coming. Trying to time the market is rough. Make sure you get 30-year fixed rate debt. Make sure it's locked in. Make sure it cash flows day one. Make sure you can afford the payment. No stretching. Don't back to the earlier question. Don't stress yourself out. And yeah, it's housing. It's we're not going back to 2010. I'm sorry. It's not gonna happen. Even though I wish it did, it's just not gonna happen.
I did a little bit of math, which is a scary concept as a police officer, but I did a little bit, just a skosh. And a $500,000 house at a 3.5% interest rate is a $2,400 a month payment. A $400,000 house at a 6.5% interest rate is a $2,500 a month payment.
Wow.
So even if prices crash 20%, which is what most people define a crash, 500K to 400K, crashed 20%. Because interest rates went from 3.5 to 6.5, which is an actual factual thing that has happened, unlike the crash in prices. Yeah. The monthly payment went up. So who's really overpaying?
Yeah, I agree.
Okay, couple questions left. This one's just a pretty easy rapid fire from Monica Galdamez. She goes, how can I grow my circle? You talk about networking all the time.
Yeah, the beauty about real estate folks in the game, we all like to talk and share an experience. So the biggest thing I would do is put yourself out there. If you can go to local meetups, go to local meetups, join Facebook groups, join Bigger Pockets groups in the areas. Be someone who contributes, and then just ask for referrals. Don't be a taker first. Give what you can. Even if you're a novice, you can answer questions, at least with your opinion, and then ask for referrals. That's the biggest thing that I tell people. I think it's number 4, number 5 of my 7 rules is you got to meet two new people a week. And the easiest thing to do is ask for referrals. If you're in Gary, Indiana, and you bump into Millennial Mike in a Facebook group, ask him for a referral. Hey, who do you recommend for this or that? People in real estate generally will help others. So just ask, be a good person. Don't just take, give first. Simple.
Totally agree. All right. Another question from Jeff M. And this is a good one. Okay. For those of us out there, Mike, who were just kids during the last crash, right? I was 17 in 2008. So Jeff M asks, he goes, Mike, you talk about consumer sentiment. How was the atmosphere in 2006? I was too young. I know realtors were saying, oh, it's a great time to buy, but were there people at that time saying that the market was overvalued then, like we're currently saying today?
I would say so. If we put in my 2005 2006 hat, it was bananas. There was money everywhere. Um, I'm trying. It kind of had a GameStop AMC meme. It kind of had a meme stock feel. Everybody thought it would go up forever. There were lending. You didn't actually have to have a loan. I mean, you could almost. I remember not filling out, signing a blank loan application. That's how stupid the lending was. Yeah, it was unhealthy. It was really bad, and it had to explode. It just had to. The movie The Big Short, people look at that as like that didn't happen. It happened. Strippers, exotic dancers, gardeners having 5, 6, 7 homes, all on these stupid teaser loans. It was bad. It was really bad. And there was only a few voices. Bruce Norris saved us. I wrote about it in my first book. I go to a meetup all excited. We have 8 houses, Michael. And we're trying to buy number 9 and can't because, again, 30-year fixed cash flow. So I never did one of those exotic loans. And yeah, Bruce Norris saved us. He was one of the few voices screaming caution, caution, caution. He actually created a report. I think you can go Google it, called the California Crash. People should research this. California Crash. He did it. I think he did it in like 2006. And then he did another one in like 2010 called the California Comeback. Bruce Norris is the OG. And yeah, he saved us. He saved us for sure. He was crazy in 06.
Yeah, I was going to say the only one I could think of was Peter Schiff because he's been calling for a crash for the last 40 years. But,
yeah.
I don't know if he gets credit.
Broken clocks.
Okay, rapid fire. Mario A asks, Michael, where can I find your 52-year history chart you keep referencing? I appreciate the help.
Yeah, so I had to put it somewhere where everybody can get it, and I'm not a techie. So Teachable is where they host my courses. So I have a free course anybody can get, and it's right there in the bonus section. So don't pay me a dime. You do have to log into Teachable and get it. It's in my free course. It's in the paid courses too, but go to the free course. It's right there.
Right. Okay, very last question. This is a good one. This is, what would young Mike say? So Holly's buddy asks, you're speaking to over 200 people at the event that you went to this last week, and your favorite course in college was public speaking. How would the freshman in college, young Michael Zuber, think if he knew this is where you would end up and this is what you would be doing? So what would younger you think of where you're at right now?
Yeah, he wouldn't believe you. I was an introvert. I mean, people may not realize that. I could be in a room of 200 people and not say a word and be totally okay. I was the fly on the wall, not very social, didn't have a lot of friends. Just, the only time I would ever get engaged if there was a ball involved, right? Soccer, basketball, football, baseball. That was kind of my jam. But even that's really a solitary thing, right? You're not really interacting. So I would not have believed you. If you would have told me I'd have been up in front of 200 people and talk. I had no power. I had no PowerPoint. I was just talking. I would have not believed it. I would have bet thousands of dollars that I didn't frankly have at the time that wouldn't be true.
Well, those are all the questions that we have for this week. There weren't any that were too particularly spicy. So to those folks down in the comment section, leave us something controversial or just keep the good questions coming. It's all we got, Mike. So sign us off.
I appreciate it, Mike. Again, thank you for doing this. I look forward to this session. I know the audience does. Where can people find you?
Yeah, if you just Google or Instagram or YouTube, Millennial Mike. Oh, and thank you, because thanks to you this morning, Business Insider just published an article about me. Little old me. I made it.
We will make that topic number 2. Thanks, buddy.
Sounds good.